Yeah, my dear students. So, one more accounting standard of our group 2, that is accounting for taxes on income. So, the areas which I would like to discuss with you is definition, difference between accounting income. Thereafterwards, I will be referring it at AI and taxable income, TI. What is the impact of this difference? That is nothing but impact of timing difference. And the last area is nothing but minimum alternate tax, a special area which we should get it covered. Minimum alternate tax. So let's revise everything very fast, my dear students. It's a very practical chapter. You would be knowing all those things, but let us brush up very fast. First of all, in definitions, I would say, what is accounting income? Very simple. It is nothing but net profit before tax as per books of accounts. Net profit before tax as per books of account. Taxable income, nothing but that is also net profit calculated in accordance with Income Tax Act. What is the net profit you calculate in accordance with Income Tax Act? That is nothing but my taxable income. So something is disallowed, something is allowed, something is allowed in the next year. So I calculate my profit and loss based on tax income. That is the amount on which I will be actually paying tax. Yeah. In what you get is accounting income. In the financial statements, P&L is nothing but accounting income. But this is memorandum. Taxable income is but nothing but a memorandum record. Now, there is a third term, that is current tax. Nothing but tax payable for current year. What is the amount of tax you are supposed to pay for the current financial year? Of course, it is calculated on which income? Based on taxable income. This is based on taxable income. The current tax. What you are supposed to pay is based on taxable income. So accounting income, net profit before tax as per books of accounts. Taxable income, net profit calculated in accordance with Income Tax Act. And current tax is nothing but tax payable for current year, current financial year, based on taxable income. Now, my dear students, there will be difference between accounting income and taxable income. The standard says this difference is due to two reasons, or they classify the reasons as two. It is timing difference or it is permanent difference. What is timing difference? Nothing but difference arising due to different in items or amounts considered for tax and accounts. Or I can say difference between accounting income and taxable income which arises in the current year and it is capable of getting reversed in the subsequent year. Nothing but timing difference. Something which has been considered in accounts will be considered in tax later. Something has been considered in tax will be considered in accounts later, and vice versa, whatever you say. So difference arising due to difference in items or amounts considered for tax and accounts, which will reverse later. When something has been debited in P&L of accounts, will be debited in P&L of tax also. Something has been credited in P&L of accounts will be credited in tax also. Maybe this is just a timing difference. I have credited it today. For income tax purpose, the same will be considered, but later on. So this difference may be due to some items. Some items are different, or the amounts for that particular items are different. That is timing difference, and this is the most important area where we will be actually doing deferred tax and all those things. But what is permanent difference, my friends? I can say difference arising due to difference in items or amounts considered for tax and accounts, which will never reverse. Okay, it is not going to reverse, means the stuff has been considered in accounts will never be considered in tax. Either as an expense or income has been considered in accounts but will never be considered in tax, and vice versa, considered in tax never considered in accounts. This is permanent difference. Like a small example, like depreciation, different rates are there, then bonus or interest is allowed only on payment basis. So these are some example. Here you can say nothing but disallowance. Something is disallowed. You paid penalty, so in accounts you wrote 2 penalty. This will be disallowed. Will never be considered under Income Tax Act. So these are referred as permanent difference. Items are considered in accounts but will never be considered in tax. Same way, agriculture income, just for understanding, will never be considered for taxable purposes, but in accounts I'll say it's my income. Nothing but permanent difference. Remember friends, permanent difference, no accounting required. You're not supposed to do any accounting for permanent difference. Just ignore permanent differences. But as far as timing difference is concerned, we recognize deferred taxes. Means accounting is done. We recognize deferred taxes as far as timing difference are concerned. Okay. So now, what is the impact of this timing difference? This is to be ignored. Permanent difference always ignored. Timing difference, accounting is to be done. Now, what is the accounting required for timing difference? What I can say, what is the impact of timing difference? Impact of timing difference. Now, what will be the impact of timing difference? My dear students, number one, as a result of difference in amounts considered, amount or item considered, the entity may end up paying less tax in current year. As a result of difference in amount or item considered, the entity may end up paying less tax in current year. Like, I purchase an asset for 100. Under Income Tax Act, 100% depreciation is allowed. Under accounts, we depreciate only 20%. So now what will happen? There is a difference. In my P&L, the depreciation is 20. In a tax P&L, the depreciation is 100. As a result of this difference, what is going to have an impact? Can I say I will pay less tax in current year? Because the P&L of tax will have 100 rupees of depreciation. So I'll pay less tax. Now friends, what is the impact of this 100 rupees of depreciation? Will lead to lesser taxable income, because for tax purpose it is 100. So lesser taxable income, less tax. Today you are paying less tax, but don't you think it will result into more tax in future? Because now in the next year, in accounts, when I say I have to charge depreciation of 20, tax people will say, no sir, this depreciation has already been allowed in the past. Entity ends up paying less tax in current year, but more tax in subsequent years. You pay less tax today, more tax in future. So what should I do? Standard says recognize defer tax liability. What are you supposed to recognize? Deferred tax liability, DTL, and your entry would be profit and loss account debit to deferred tax liability. Now friends, I hope now you would be getting the other. See, second stuff. As a result of difference in amount or item considered, the entity may end up paying more tax in current year, but less tax in subsequent year. Like what has happened is, say I just take up the reverse scenario of my previous example, that I purchased an asset for 100. Income tax people will give me depreciation of only 20, whereas for accounts purpose I am considering whole 100. So in accounts 100 is the expense, and tax it is only 20. So don't you think my taxable income will be more? If taxable income is more, I pay more tax. But of course, today it is more tax. In subsequent year, what will happen? I will not charge depreciation, but tax people will still give me depreciation 20, 20, 20. It means I will pay less tax in subsequent year. Standard says, what should we do? Recognize deferred tax asset, DTA. And what will be your journal entry? DTA account debit to profit and loss. And of course, when the timing difference arises, we pass an entry. First time, originate. When the timing difference originate, we pass an entry P&L to DTL. And thereafter, reversal will happen. So we have to reverse of the entry, DTL to P&L, DTL to P&L, something like that. Same way, when the timing difference arises, and for the first time, there has been the impact on the tax, we say DTA to P&L. And subsequently, when the timing difference will reverse, we will reverse of this journal entry. So my dear students, this is this stuff. Yeah, this is the impact of your timing difference. Of course, permanent difference, no need to have any stuff. These questions are already done. And just come on a small past paper question. Rohit has provided following information. Of course, this is with respect to transition adjustment, but then also for our understanding. Depreciation as per accounting records is 250. Depreciation as per tax records is 550. Unamortized preliminary expenses 40,000. Now, just my dear students, look at here this point. Depreciation as per accounts 250, depreciation as per tax 550. So don't you think 3 lakhs is the difference between these two? As a result of this 3 lakhs, what will happen? My P&L of accounts is 250 debit. My P&L of tax is 550 debit. It means more expense under tax laws. More expense under tax laws. So taxable income will be less. Taxable income is less. Less tax today. Today I will pay less tax, but in future I have to pay more tax. Don't you think this will lead to DTL? But this DTL is not 3 lakhs, because 3 lakhs is the timing difference. Deferred tax is nothing but timing difference into tax rate. So my timing difference is 3 lakhs. My tax rate is 50%. So can I say 3 lakhs into 50% will be nothing but 150,000. So 150,000 will be the DTL, deferred tax liability. Now the second stuff, unamortized preliminary expense as per tax records, 40,000. Unamortized means the amount is not yet written off. My dear students, don't you think as per accounts we write off the amount immediately? Preliminary expense can never be deferred. It is compulsory to be written off in accounts. So in accounts, what is happening? 40,000 will be there in P&L of accounts. In tax, 40,000 will not be there. This amount is not written off. So something is written off. Say for example 50,000. So out of 50,000, income tax people say only 10,000 is expense for current year. 40,000 will be expense in the remaining years. So 40,000 is unamortized. Under accounts, nothing is unamortized. Everything is going to P&L. So now what is happening? In accounts, I have 50,000 expense. In tax, I have only 10,000 expense. The difference is 40,000. Because of this, what has happened? In tax, the expense is only 10 as compared to accounts. Don't you think my taxable income has increased? It will result to paying more tax in current year and of course less tax in subsequent year. So it will lead to DTA, deferred tax asset, which is 40,000 difference into 50%, that is 20,000. Yeah, so net deferred tax liability of 130 should be recognized. Now one more point I would talk with respect to recognition of DTA. Standard says you should recognize deferred tax asset. Nothing wrong in that recognition of DTA. But when you recognize this deferred tax asset, you need to consider a concept of prudence. In relation to carry forward loss or brought forward depreciation, and in relation to others. My dear students, you just need to remember that in relation to carry forward loss, you need to have virtual certainty of taxable income. Then only create deferred tax asset, because what is going to happen? My loss will be carried forward. So don't you think my future tax will have an effect? So virtual certainty of future taxable income. In relation to others, I require only reasonable certainty of future taxable income. That reasonable certainty comes from past record or good sales order book and all those things. That gives you reasonable certainty. Virtual certainty means it's going to happen. Then only you create DTA. Otherwise, don't create DTA. So my friends, this is with respect to recognition of DTA. Now let me come upon one more area, that is nothing but MAT, minimum alternate tax. Now, as per Income Tax Act, entity is required to pay tax which is higher of following. Number 1, tax on taxable income based on normal tax rates. And second, tax on book profit based on MAT rates. So this is the provision of income tax. We are not playing any role in accounting standards. Why this is there and all these things. Income tax act says you have to pay higher of following: tax on taxable income based on normal tax rate and tax on book profit based on MAT rates. So say for example, MAT tax is 100, this is 200, so you'll be paying what? 200. But if it's this way, MAT tax is 100, income tax act normal tax rate, which is generally 30%, is 20%. Tax amount is 20, I'm sorry, not percent. Tax amount is 20 and this is 100. So you have to pay which tax? Obviously, whichever is higher, 100. Now, if an entity pays tax as per MAT provision, means 100, then it is eligible to MAT credit which is excess of MAT tax over normal tax. Deferred tax are to be measured using normal tax rates. So what is our normal tax rate? Based on that only deferred taxes have to be measured. You're not supposed to measure the deferred tax based on MAT rates. So if MAT rate is say 15%, normal tax rate is 30%, but MAT tax is on book profit, normal tax is on taxable income. Yeah, so my dear students, we will be paying tax based on whichever is higher. So the day I pay tax based on MAT profits, I'm going to get MAT credit also. Then it is eligible for to MAT credit, which is excess of MAT tax over normal tax. So deferred taxes should be measured using normal tax rates. I'll do one question which is already solved. Yeah, but I'll solve it in our JKSC way. Sheetal has provided information. Question number 3. For the year ended on 31st March 19, accounting profit 9 lakh, book profit as per MAT 525, book profit as per Income Tax Act, profit as per Income Tax 95, tax rate 30, MAT rate 7.5%. Now see friends, first of all, what is my profit based on normal tax rate, or I can say not normal, I'll say tax based on normal provisions. Normal income tax provision. What will be the tax based on normal income tax provision? Nothing but your accounting profit 9 lakh, that is to be ignored. Can I say 95,000? So it will be 95,000 and my tax rate is 30%. So 95,000 into 30%, my friends, I'm getting 28,500. Second, tax based on MAT provisions, minimum alternate tax provision. That is nothing but always based on book profit as per MAT, 525 into 7.5%. 5,25,000 into 7.5%. 39,375. So what is the amount of tax you are supposed to pay in the current year? What will be the amount of tax you have to pay in the current year? My dear, it will be 39,375 is the tax which you are supposed to pay in the current year based on MAT provisions. But obviously, you will be getting MAT credit, which will be 10,875. What is this MAT credit? Nothing but excess of MAT tax over normal rate. Now, I have to create deferred taxes. My accounting profit is 9 lakh. So let us come on deferred taxes. My accounting profit 9 lakh. My taxable profit. What is our taxable profit? 95,000. So can I say this is nothing but timing difference? How much is this timing difference, friends? 8,05,000. Accounting profit is more than taxable profit. It means I will pay less taxes per taxable profit here. So I will create a DTL. I have to pay less tax. How much? 8,05,000 into what rate? MAT rate or normal rates? Always normal rate, 30%. So 8,05,000 into 30%. 2,41,500. Okay, friends. So I will be creating a DTL, profit and loss account debit. Profit and loss account debit 2. Deferred tax liability 241,500. And my current tax will be 39,375. And of course, I will be having a MAT credit which will be creating profit and loss. Yeah, my tax expense is 270, nothing but don't worry about 270. It is nothing but 241,500. Yeah, plus you can say MAT tax 39,375 minus MAT credit 10,875. So your total current tax plus deferred tax minus MAT credit is nothing but your tax expense. Yeah, don't worry about this workings and all those things. The amount which will get debited to PNL. How much amount you will debit to PNL? Sir, 39,375 plus 2,41,500. 2,80,875. This amount will be debited and 39,375 will be debited. Yeah, that is 2,80,875. So for current tax, please pass an entry, profit and loss account debit to current tax, 39,375. For DTL, pass an entry, profit and loss account debit to DTL, 2,41,500. This total is the amount debited to PNL. For MAT credit, your entry will be MAT credit to PNL, 10,875. Merge these 3 entries, you will get tax expense. Okay, friends, so this much from my side for our MAT part. All the best for your exams. Thank you very much.